Warren Buffett just released some straight up gems in the latest Berkshire Hathaway letter to investors. He's always known for being informative with his letters, but this one in particular is one that you should save and refer back to for years to come. Whether you're a seasoned investor or just starting out in your investing journey, these are lessons that can be applied in any stage of investing. So let's take a look. If you are interested in business and investing, you should learn about Warren Buffett. As CEO of Berkshire Hathaway, he's done truly amazing things since he took over. From the year 1965 to 2022, the value of Berkshire Hathaway has grown at a rate of almost 20% every single year. This is twice as much as the S&P 500's 10% annual gain. And when you consider this type of performance over 58 years, the separation becomes even more staggering. Every year, Buffett sends a letter to his shareholders that's full of wise advice and useful information, and he just sent out a new letter to end Berkshire Hathaway's fiscal year for 2022. In this video, we'll take a look at 5 lessons that you can learn from Warren Buffett's 2023 annual letter, including one particular lesson that he calls the secret sauce. Let's begin. The first lesson highlighted by Buffett is to own stocks based on expectations about their business performance and not based on price movement. He mentions that the goal here is to make meaningful investments in businesses with both long-lasting favorable economic characteristics and trustworthy managers, and that, as he quotes, we own publicly traded stocks based on our expectations about their long-term business performance, not because we view them as vehicles for underwrite purchases and sales. Now, a lot of inexperienced investors make the mistake of buying stocks because they think that the price will go up, and don't base it on any sort of in-depth analysis of the business. Warren Buffett's lesson here is to buy good businesses, not hot stocks. Now, this strategy has generally been successful, but it doesn't mean that it's perfect. Buffett himself has actually said, "Over the years, I've made many mistakes. Consequently, our extensive collection of businesses currently consists of a few enterprises that have truly extraordinary economics, many that enjoy very good economic characteristics, and a large group that are marginal. Along the way, other businesses in which I have invested have died, their products unwanted by the public. Capitalism has two sides. The system creates an ever-growing pile of losers while concurrently delivering a gusher of improved goods and services." Schumpeter called this phenomenon creative destruction. Even with this, he still managed to average an annual return of 20% over almost 60 years. And although Buffett himself is modest in his self-assessment, what this really highlights is that when you make a habit of sound investing decisions, the overall results are more likely to be favorable, even when some of those decisions end up with unfavorable outcomes. So you're more likely to go 6 for 10 if every of those 10 decisions are sound investment decisions, as opposed to going 2 for 10 or 0 for 10 if you just blindly make an investment based on FOMO, luck, or just because some dude down the street told you to buy a certain cannabis stock, for example. The next lesson highlighted by Buffett, which is the secret sauce, is that dividend growth over time works results in winners. Going to the letter here, he says, "The cash dividend we received from Coke in 1994 was $75 million. By 2022, the dividend had increased to $704 million. Growth occurred every year, just as certain as birthdays. All Charlie and I were required to do was cash Coke's quarterly dividend checks. We expect that those checks are highly likely to grow." American Express is much the same story. Berkshire's purchases of Amex were essentially completed in 1995 and coincidentally also cost $1.3 billion. Annual dividends received from this investment have grown from $41 million to $302 million. Those checks too seem highly likely to increase. Buffett uses the examples of Coca-Cola and American Express to show us how a business that does well over a long period of time can make a big difference, even if there are some mistakes along the way. Coca-Cola has seen a huge growth in dividends and a huge rise in value. Just from dividend payments alone, Warren Buffett's initial investment has grown by more than 100% every 2 years. Think about that, 100% every 2 years. Now, this money has given Buffett the buying power he needs to buy more businesses and make even more money in the future. And he sums this up pretty well by saying, "The lesson for investors is the weeds wither away in significance just as the flowers bloom. Over time, it takes just a few winners to work wonders." And yes, it helps to start early and live into your 90s as well. The next lesson here from Buffett is that share buybacks at value prices benefit all owners of the stock. Buffett explains simply the value of share buybacks while at the same time using some stern language towards those that are against share buybacks. In his letter, he says, "At Berkshire, we directly increase your interest in our unique collection of businesses by repurchasing 1.2% of the company's outstanding shares. At Apple and Amex, repurchases increased Berkshire's ownership a bit without any cost to us. The math isn't complicated. When the share count goes down, the interest in our many businesses goes up. Every small bit helps if repurchases are made at value accretive prices. Just Just as surely, when a company overpays for repurchases, the continuing shareholders lose. At such times, gains flow only to the selling shareholders and to the friendly but expensive investment banker who recommended the foolish purchases. Gains from value-accretive repurchases, it should be emphasized, benefit all owners in every respect. When you are told that all repurchases are harmful to shareholders or to the country, or particularly beneficial to CEOs, you're listening to either an economic illiterate or a silver-tongued demagogue, characters that are not mutually exclusive. And this makes perfect sense. If you can sell shares to get money, which dilutes and reduces the ownership stakes of your investors, then why can't you do the exact opposite by investing money in your business to increase the ownership shares of your investors? When a company overpays for repurchases, as Buffett says, the people who still own the shares lose. And this is just how the market works. Lesson 4 is to know the management of a company well enough to trust your money with them. Buffett states this in his letter, and he says, "There are many Berkshire centimillionaires and yes, billionaires who have never studied our financial figures. They simply know that Charlie and I, along with our families and close friends, continue to have very significant investments in Berkshire, and they trust us to treat their money as we do our own." The point here is when you're investing in a company, realize that you're literally handing your hard-earned money to a company, and you need to be certain that whoever is running that company is good enough to grow your money. So as part of your analysis at picking a company, you need to get familiar with who the management is and look at the track record to determine whether or not they're fit for the job of growing your investment. The fifth lesson here is that investing in American companies is a safe bet to increase your wealth. Buffett highlights that Berkshire Hathaway would not be where it is today without its investment in the American economy and American businesses. And he says in his letter, "Thus began our journey to 2023, a bumpy road involving a combination of continuous savings by our owners, that is, by their retaining earnings, the power of compounding, our avoidance of major mistakes, and most important of all, the American tailwind. America would have done fine without Berkshire. The reverse is not true." Berkshire now enjoys major ownership in an unmatched collection of huge and diversified businesses. Let's first look at the 5,000 or so publicly held companies that trade daily on the NASDAQ, the NYSE, and related venues. Within this group is housed the members of the S&P 500 index, an elite collection of large and well-known American companies. At year-end 2022, Berkshire was the largest owners of 8 of these giants: American Express, Bank of America, Chevron, Coca-Cola, HP Inc., Moody's, Occidental Petroleum, and Paramount Global. In addition to these 8 investees, Berkshire owns 100% of BNSF and 92% of BH Energy, each with earnings that exceed the $3 billion mark noted above. $5.9 billion at BNSF and $4.3 billion at BHE. Were these companies publicly owned, they would replace 2 present members of the S&P 500. Now, these are staggering numbers and prove Buffett's point that owning American companies is never lose an idea when trying to increase the value of your portfolio, especially when all the companies that you're looking at are among the biggest in the world and are projected to continue to grow going forward. Now, these 5 lessons I've told you about today are just a small part of Buffett's most recent letter to shareholders. For the full letter, please check out the link in the description below. It's quite the entertaining read. Thanks again for watching. Drop your comments down below after you've read it. What do you think of the points I've outlined in this video? And is there anything that you look to start incorporating in your investing strategy? Drop a comment down below. Once again, thanks for watching, and I'll catch you in the next video. Peace.